Good morning, ladies and gentlemen. Welcome to this Super Bowl edition of the video. Today we thought we would do something slightly different, and that is step back from all this noise on a daily basis and actually look at what could be a major trigger for the remainder of the year in terms of trends. We have to look at something which has been puzzling us for the past several weeks, and that is, why is the US curve in fixed income behaving the way it is? We must admit we don't have an answer, but we have lots of questions and we are puzzled. As you can see from a weekly chart of the 2-year note, it's basically doing nothing. You have a whole series of little green candles with closes very similar to each other but slightly positive, i.e. the 2-year in terms of yield is, if anything, decreasing. In terms of price, it's rising, while the 5-year is doing very much the same thing. Here is the 5-year. It is doing absolutely nothing. It is closing very close to the close of the previous week, within 1 or 2 basis points, while the 10-year is slightly worse. It is not sustaining the rallies of the previous weeks, and in terms of beginning of the year, it is almost unchanged. The one that is therefore puzzling us is the 30-year bond, which is completely unable to sustain any kind of rally. And that is the puzzling part, because if the data from the States is strong and the expectation is for a further tightening of rates from the Fed, you would have thought that the 30-year bond would be the one which would be the firmest, and the 2s and 5s would be the ones that are getting hit. Therefore, you would expect a flattening of the bond curve, and we are getting exactly the opposite. We are getting a steepening of the bond curve. 2s are doing nothing, 30s are coming off, the yield curve is steepening, and that is telling us something. We just don't know what it is that it's telling us, and we thought that we'd use this video as a look through as to what the implications of that might be. Absolutely the same thing is happening in Europe. This is a chart of the Schatz, i.e. the 2-year note, and this is a chart of the Bund, which is the 10-year. You can see that the last time we had this spike, which was back in June, the Schatz is absolutely unchanged from those levels that we had in June, while the Bund, which spiked to 169 almost, is now a good 600 ticks lower than it was at that stage. This is where we would expect it to be if the curve was remaining the same. The curve is quite obviously steepening very much in Europe as well. That to us makes sense, because the expectations of an end to QE would first of all weaken the long part of the curve, and only subsequently, right in front of it, weaken the front part, the 2-year note and the 5-year note. So that is expected, but the move in the States is not expected, and that should have an explanation which could have very important ramifications for all other trends this year. So that becomes our question. why are people uncomfortable holding 30-year yields above 3%? So, absolutely a positive yield when they are quite comfortable holding European bonds at even negative yields. Makes very little sense to us that people would not buy dollars and invest in the United States. There is something going on, or some expectation that is preventing them from doing that, and feeling and making them feel uncomfortable with holding a positive yield in a strong currency like the US dollar. There must be something that the market is seeing round the corner that makes it uncomfortable. And we've been racking our brains to try and see what that could be. It is undeniable that the 30-year bond is the weakest one in terms of yield. It seems that the market wishes to push the yield back up to at least 340 to 350, while it's much more comfortable with holding 5-year Germany at -40, and it's much more comfortable with holding 2-year notes at negative real yields, given that inflation is very rapidly approaching 2%. And for the past few days, we have been racking our brains to see what that could be. And we have looked at all the interrelated contracts, and the only thing that we can come up with are these charts. The first one is a equal weight commodity CRB index. The second one is the Bloomberg Commodity Index, and the third one is the Goldman Sachs Commodity Index. The first one is the least weighted towards energy prices, while the third one is the most weighted towards energy prices. You will agree that after a huge rundown, these markets are beginning to look technically as if they are building an inverse head and shoulders in each one of them, with very important levels that we have marked down in each. So in the first one, 438 and a quarter, in the second, 90 and a third, and lastly 420.85 in the Goldman Sachs index. All the moving averages have turned. These are weekly charts, therefore quite long term, and this could be what the market is telling us. The market could be telling us that pricing power is about to come back into the world markets through a surge in commodity prices. We like these indices because they are not only weighted towards energy, they have very large components of industrial metals and softs. And the more you go towards industrial metals and softs, i.e. towards the left chart, the more you get a perfect picture of an inverse head and shoulders, which could be about to break to the upside. This trend line is a trend line all the way down from the highs made in 2011 after a huge rally that we had after the fall in 2008. This could be telling us that pricing power is indeed beginning to return to the markets, which would make sense because we've had a big rally in the Australian dollar. We are having a rally in emerging market stock markets, far stronger than the rally that we are having in ES or NQ. And that could be the answer to our question. We cannot tell you how important it is that we watch these levels, because if we now get breaks above, we are now getting signals of a return of inflation and pricing power to the markets, and that is going to have huge consequences for trends. It is going to tell us that potentially we're going to see a very large reversal in the dollar, that we are going to have a period of huge outperformance of emerging markets over the developed markets, and also that we are going to have a pronounced period of bond weakness, which we certainly did not expect even last week. Just to make that point and emphasize it, we have had this week a break in the Australian dollar outside of this channel, which has held since 2011. Is that significant? Well, we're beginning to think so. If the market now clears the 77.5 area and then clears this 200-week moving average, we will certainly be having signs of inflation and commodity strength coming back into the markets, and therefore pricing power, and therefore equity positive, negative for bonds, and we should have our next big trend. Having said that, let's go back to the commodity index and look at these levels again. We've set alarms at all of them. This one is the one we like most, which is the equal weight CRB, 438.25. We think that that is going to be an incredibly important level. If we look at where we are in the cycle, this is the high in 2008, where the market was trading just above about 900. We are now at 400. So you can see how large a move that could be in terms of having rejected these lows and now pushing back up. This could be the ultimate confirmation of the Trump reflation trade, but with very different implications for the dollar. We find it very hard to believe that the inflation trade can take place with a strong dollar. Therefore, it now looks likely that the reflation trade will take place, but with very different consequences for the US currency. The euro has actually been stuck in this upward channel for the past several weeks, and even good figures on Friday did not manage to weaken it significantly. Odds now return to moves higher towards 109 and eventually 110, which the Swiss franc has already reached retracements above this level, which is around 108.75. So it looks like we will have certainly rallies towards 108.75, 109 in the next couple of weeks. And it also looks likely that we will have further strength in the Australian dollar. Certainly we would like to see it back up towards 79, and then if we can break 79, we have a clear path towards 90. Those are very major moves that we could be having in the Australian dollar and in the dollar in general, because if we look now at these charts that we've shown you before, we are having a definite breakdown of the relationship between the 5-year yield and the DX, the weighted dollar index. This chart is doing almost nothing. If anything, it looks like it wants to break to the upside, while the dollar index is definitely weaker than one would expect it. One at the moment would expect it to be trading around 102, and it's trading below 100. This definitely has implications. It has implications for inflation, and therefore pricing power, and therefore the relationship between equities and bonds. There is not much point in showing you the usual charts of the fundamentals in the stock market. Absolutely nothing has changed from last week. Therefore, we shall look at the biases for next week. This is what we wrote last week, turning to bullish in the 5 and 10-year note. Watching for the close below 117.04 in the 5-year note to reverse to a short. And in TLT we said we're neutral and we need to go above 122.70. Well, now we've added watch for breaks below 117 as the yield curve steepens, and we are adding this very important caveat: watching those levels in commodity indices where we set the trigger for short TLT and US bonds. In the European markets we are still neutral, and in the bubble we are looking for these levels 25 to 45, where the market just about got to put in some sizable shorts with a stop above 133.65. Not sellers down here no longer applies, because we have rallied from that 60 level as we thought we would. So these are very important levels to us. 133.25 to 45 in the bubble we will be looking to short, and in the Bund 163 to 164 is a definite shorting area. Nothing has changed in the equities. We still don't like ES, we prefer NQ, and we definitely prefer the Russell. We are adding this sentence, which we think is important. We think that if we do get some triggers from the commodities and from the bonds, the Russell is going to outperform the ES over the next several weeks. The pattern there is far clearer, and we will definitely have a larger move in the Russell as opposed to the ES. European equities, nothing's changed. They can't get above 33.25. We prefer to buy a close above 33.25 rather than a close below it, because above 33.25 shows momentum. At the moment we have no momentum, and we are subject to silly breakdowns for no reason. And in the US dollar, we certainly think that volatility is the order of the day. We were right to turn bearish last week and buy 106.50. We think this week, while we will probably trade it short somewhere around 108 and 3/4 to 109, we could definitely have peaks up there, and we're adding look for long opportunities in the Australian dollar. Again, that will be subject to these triggers in the commodity indices. We think that we have found what is going to drive the next trend. Let's take advantage of it, because certainly we think if the commodity prices spike above those levels earlier in the video, we will have large moves in the dollar and especially in the Australian dollar. Happy Sunday, watch the Super Bowl, and let's hope we have some good trading opportunities next week.